Let's dive right into today's explainer, where we're unpacking the highly anticipated May 2026 Advanced Economic Analysis Report, Gold, Myth or Reality. If you're already dialed into how global wealth moves, you know gold is always a hot topic. But today, we're stripping away the noise, the fear-mongering, and the hype. We're looking purely at the hard data to explore the history, mechanics, real risks, and the actual future of gold in a modern portfolio. So let's tackle the biggest question head-on. Is gold actually safe? You know, for 5,000 years, humanity has treated this shiny yellow metal as the ultimate fail-proof safe haven. But as we're going to see from the data today, it's a much more nuanced story. The source material really challenges this deeply ingrained assumption, proving that gold isn't exactly a magical shield that protects you from every single economic storm. Just wrap your head around this massive number, 863 tons. According to the May 2026 data, that is exactly how much physical gold central banks bought in 2025 alone. They've been net buyers for 15 consecutive years. It absolutely validates the asset's massive institutional relevance. Think about it. Despite all the insane digital innovations we have in finance, the world's most powerful financial institutions are still actively hoarding physical gold. To understand why institutions are hoarding it, we have to look back at how gold's role has actually evolved. Back in the late 19th century, it was a classic fixed standard. Currencies were literally backed by the metal. Then we hit 1933, a really shocking moment when the U.S. government actually confiscated private gold. Fast forward to the 1971 Nixon shock, which ended Bretton Woods and severed the dollar's tie to gold entirely. And that brings us to today, in 2026, where we're in a free-floating fiat regime and gold is hitting historical price records. Now, here is a crucial takeaway from the report. The concept of the imperfect hedge. This is a major strategic insight. People constantly buy gold thinking, well, it always goes up when stocks go down. But the data shows its correlation with equities actually fluctuates over time. In fact, during extreme panic liquidations, like what we all saw back in March 2020, gold can drop right alongside stocks as investors just scramble for cash. So it offers partial protection, for sure, but it is not a perfect impenetrable shield. This dynamic brilliantly highlights the great divide among financial titans. Take Ray Dalio, for example. He includes gold in his famous all-weather portfolio, arguing it's an absolutely essential protection against inflation and central bank money printing. But then you have Warren Buffett, who harshly critiques gold simply because it produces zero cash flow. It doesn't pay dividends, it doesn't grow crops. Buffett views it as purely speculative. You're basically just hoping someone else pays more for it later. We're not taking sides here, but understanding both of these perspectives is super important. All right, prepare yourself for a stark reality check, minus 70%. Between its peak in 1980 and the year 2000, gold suffered a brutal 70% nominal drawdown. Let that sink in for a second. If you bought at the peak in 1980, you waited over 2 decades just to recover your capital in nominal terms, and even longer when you adjust for inflation. It completely shatters the myth that gold only ever goes up. Which brings us to a famously sharp historical perspective. The gold standard is a barbarous relic. That quote from legendary economist John Maynard Keynes perfectly captures the view held by many modern Keynesian economists, like Paul Krugman. Their argument, tying a dynamic modern economy to a physical chunk of metal, is totally outdated, inflexible, and driven way more by fear and ideology than by sound macroeconomic fundamentals. Section 2, how it works in practice, and the illusion of equivalence. Let's pivot to the actual mechanics. Because the source material makes one thing absolutely clear. You cannot treat different types of gold exposure as the same thing. They are totally different modalities. With physical gold, you have minimum counterparty risk because, well, you're physically holding it, but your liquidity is much lower. Now, with a backed ETF, you get high liquidity by trading on an exchange, but you instantly introduce counterparty risk. You're relying entirely on the fund manager and the custodian bank. And finally, futures contracts give you leverage and high liquidity, but introduce clearinghouse and margin risks. Simply put, an ETF is not a gold bar in your hand. So where does the physical demand actually come from? Looking at the recent data, excluding ETFs, the answer might surprise you. A massive 45% of demand is just jewelry. Central banks come in second at 21%, followed by physical bars for investment at 19%. There's even a 6% slice just for electronics, since gold is highly conductive and resists corrosion. This kind of diverse demand structure is really unique among financial assets. Here's a highly specific strategic insight from the report, specifically regarding the Brazilian market. Remember, gold pays zero interest, so your opportunity cost is whatever you could be earning in a risk-free asset. In Brazil, which historically has some of the highest real interest rates in the world, like the Selic rate, holding zero-yield gold comes with a massive opportunity cost. However, Brazilian investors also use it because it's priced in dollars, offering a distinct layer of currency protection whenever the local currency depreciates against the US dollar. Now let's break down the real risks and possible scenarios outlined in the May 2026 data. We already mentioned the 1933 US confiscation. That's your classic sovereign risk. But in the modern retail market, there is the documented risk of accidentally buying fake bars filled with tungsten, which actually has the exact same density as gold. Crazy, right? Then there's counterparty risk in ETFs, currency risk because the price is linked to the dollar, and finally, in extreme market shocks, physical gold can suffer from severe liquidity failures where the spread between buying and selling gets incredibly wide. Of course, we have to address the elephant in the room. The report neutrally compares gold to Bitcoin. Think about it. Gold is physical, has a 5,000-year track record, and is held as a reserve by central banks. Bitcoin, on the other hand, is purely digital, only 16 years old, has zero physical backing, and extreme volatility. The International Monetary Fund even notes that the popular narrative calling Bitcoin digital gold often completely ignores this massive difference in historical volatility and physical utility. Looking ahead, the May 2026 report highlights some fascinating strategic insights for the future. We're closely watching the rise of central bank digital currencies, or CBDCs, which could totally alter the global monetary system. We are also seeing the tokenization of gold on blockchains, basically attempting to make transferring physical gold as easy as sending an email. And underlying all of this, rising geopolitical tensions are explicitly cited as the primary motor keeping central bank demand so incredibly strong. Which leaves us with a final, provocative thought. Will gold lose its relevance in the digital age? As our financial systems become entirely electronic, tokenized, and driven by artificial intelligence, does a heavy yellow metal still deserve a prominent place in the vaults of central banks and the portfolios of everyday investors? The data suggests its role is definitely evolving, but its psychological grip on the global markets? Yeah, that's far from over. Before we wrap things up, a quick but important reminder. This explainer is strictly 100% educational content based on the May 2026 data. This is absolutely not a recommendation to buy, sell, or hold any asset. All investments involve the real risk of loss, so please always consult a certified financial professional before making any investment decisions. If you found this breakdown valuable, make sure you follow the Macroeconomia channel. We're constantly bringing you the best data-driven insights bridging macroeconomics, artificial intelligence, and technology. Go ahead and access the links in the description below to dive deeper into the sources, follow our channel, and make sure those notifications are turned on so you don't miss our next explainer. Thanks so much for learning with us, and we'll see you next time.